All right. Meantime, the Japanese yen touching its lowest level against the dollar since late April, trading near 160. It's hovering near its lowest levels in over 30 years. Let's bring in BK Asset Management's Kathy Lien for more. Kathy, 160 is like the line in the sand, 160, 165. And so do you think that the BOJ will actually step in?
I think they're going to have to. I think that, if traders take it above the April high and we don't see any evidence of the Japanese government coming in, they're going to push it even higher. The real question, Melissa, is whether it's going to work, because we saw how the charts moved in April and the intervention was very short-lived.
I mean, I almost feel like it's a foregone conclusion that it won't work. I mean, when has intervention actually worked? And so how do you trade that with the knowledge that they'll probably step in and it probably won't work?
Well, as traders, it's very dangerous to be holding any type of short yen position at these levels. If you are short yen, it must be very small positions. And I think, even if you have stops, they're going to be slipped incredibly. So the best bet is probably when you have intervention to ride that wave for a very short-term move. But usually, within a 5-day period, the intervention effects tend to fade. So you could also wait it out. Wait for the initial volatility to settle and then get back in, knowing that nothing has really changed for Japan.
Kathy, how much of this, Tim, thanks for joining us, how much of the recent move do you think gets back to central bank differentials? Because I don't think a lot of the move over the last, say, call it back 6 months for the previous 2 years was necessarily central bank differentials, even though we know the Fed's been aggressive. The BOJ, certainly the conversation is on a relative basis to where they've been. You can make an argument that the BOJ, the delta there on their hawkishness was, even more than the Fed. But obviously, with the Fed pulling back on cuts this year, the sense that the Fed is maybe the most hawkish of the major global central banks, do you think that's an issue? Because it hasn't seemingly historically been the issue with the yen carry trade.
I think it's absolutely been an issue. I think that the dollar is strong, and that is what's driving up dollar yen. The market shifted dramatically after the last dot plot came out. And at the end of the day, even though the BOJ may be more hawkish on a relative perspective than the Fed, interest rates in Japan are next to nothing compared to the more than 5% rate in the U.S. So they're going to need to do a lot more work to keep those funds domestic in Japan. And I think that's one of the most serious problems.
There's another meeting in July, Kathy, and I'm wondering if you think the BOJ will punt bond buying further down the road, or if they'll actually engage or give us an outline.
I think that they are going to engage in the bond buying changes, but the question the market really is looking for is whether that's going to be accompanied with a rate hike, because we really need that 1-2 punch to kind of carve out a bottom in the Japanese yen. I think that, right now the market's still very, very uncertain with whether we're going to get that interest rate hike if they do change their bond buys, and I think it's part of the reason why the yen remains so weak.
Kathy, what level do they start talking about a currency crisis? Because I think it's happening in slow motion.
Well, I mean, at the end of the day, they focus more on volatility than the currency level itself, right? So right now, volatility of 1-month implied options are still significantly lower than where they were in April when they came into the market. So they told us they don't target the currency. They focus more on volatility. But I would have to say that above 165 is where it really becomes trouble.